Hey, my name is Michael and welcome back to my YouTube channel. In this video today, I want to talk about inflation because I think what is happening right now in the United States is very significant. What we're seeing is a lot of money that's being pumped into the economy, essentially printing trillions of dollars that is really going to cause a significant amount of inflation. We're probably going to see it I think in about a year or two from now. And it's going to cause some problems. So I wanted to just make this video, pretty simple, just go over again what inflation is, and then there's the pros and the cons and how you probably could benefit or at least keep your money safe during this time, because we can expect inflation to occur significantly in the near future. So let's go over just a basic example of inflation in case you may have forgotten from your economics class. Inflation basically just means that the value of something is going down because there might be more of it available or it's not valued as much. And so an example that I like to use is, let's say you have $100 and what you do is you have the $100 and let's say you bury it in your backyard and you keep it there for 10 years. And then 10 years goes by and then you pull up that $100 and then now you try to buy something with the $100. And if you do a comparison in history, from buying something 10 years ago to now with the same amount of money, so the $100, you'll notice that you have less buying power today with the $100 than you did 10 years ago. And that really just sets an example of what inflation is. We're seeing it with the US currency. The value of it's just going down because we're printing artificial money, which is being pumped into the economy, and then lowering the amount of value that each dollar bill holds. So again, we're going to see huge inflation probably in a year or two, so keep that in mind. So how can the banks or such kind of regulate how inflation happens? Every year you might be seeing maybe a 2%, 3% inflation rate, but how can that actually be controlled or at least mitigated to some extent? So what can be done though in this scenario is you can adjust the interest rate on savings accounts. So what that would do is that would encourage a lot of people to save money and just hold it on site and to make that extra savings by just having it available in your savings account. In the United States too, what's been interesting is that the philosophy of America is that the banks typically don't offer a high interest rate. And so a lot of people don't end up saving money because there's really no benefit or value add of holding on to your money. Also, the government could go back and try to buy available stocks to help reduce the amount of money that is flowing through the economy. So essentially what that would do is reduce the surplus of cash available, therefore making the value of money more powerful, and another way to try to mitigate inflation. So sometimes government can try all these tricks to try to control inflation. Obviously, controlling inflation is important. And if it goes out of hand, let's say you use all your tools and the system is still essentially broken, then you're going to have a problem. So you might be also thinking, what does inflation encourage? Let's say because the interest rate on your savings account might be low. One more thing to add, if the government is trying to control inflation, another way they can do this is trying to find ways to banks can tighten lending requirements, so it's harder to get money. So it makes it a little bit more challenging for investors to go out there and try to make a profit. So they'll probably consider twice, the interest rate might be higher for holding loans, and that's going to affect your ROI. So that is another way to just encourage saving. So now you might be thinking, what does inflation encourage? So if everyone is aware of inflation and maybe it's growing really fast, what that means is that a lot of people are going to want to spend their money immediately because basically the money is devaluing at an extraordinary rate. So you want to try to buy things immediately before you have to spend twice as much to get the same product. So what you'll see if there's a lot of inflation and people are aware of it is that once they collect their paycheck, they're going to buy something immediately with it. That might be food, that might be stocks, some way that it makes it feel like people are getting their money's worth. What likely happens during inflation, it's a common trend, is that typically, there's more money floating in the market, and so there's a less unemployment rate. There's a lower unemployment rate, and with this, it makes it a little more challenging for employers to pay someone the same amount. So what you're going to see is a lot of employees are going to switch jobs every couple of years to get an additional raise. But the thing though is that everyone's going to be switching jobs every couple of years, which means that employers have to pay more for their employees, which just gives back more money to the economy because now the employees are going to buy products And you kind of get this spiral effect where inflation just keeps happening and it can become out of control. So that can be a concern on the other end of the spectrum. So now you might be thinking, okay, we just heard, the cons of inflation. You might expect that people might want to save their money, or the pros, wages are going up and so forth. And you might be thinking, and I think a lot of us are thinking right now, since a lot of us are expecting inflation to occur, like I said, in a year or two. So how can you mitigate the money you have right now, or at least protect it, so that you don't have to undergo inflation where you feel like you need to spend your money immediately, so you're hedging against it? Or if you're holding on to a lot of money right now that you feel like you're losing and it's devaluing over time due to inflation. And so I think what you can do to help hedge against inflation, or at least try to, is have money in equity. And this can be equity, anything from real estate or stocks or an investment vehicle. And the reason why I say equity is on purpose and specifically is that equity will hold its value in terms of its shares over time. So if something goes up in value and you own equity, that percentage multiplies out. The problem is though, if let's say you own a stock, and what might happen from a company side, company perspective, is that they might actually split the shares, and then now you're essentially breaking up the amount of money that you have available, because now it's broken into smaller shares, and those shares can go down in value. So that is a concern. But if you own equity, the example that I really understand, say you own equity in a piece of real estate, right? So the value of that property is probably going to go up due to inflation, because you need more money to purchase that same property, and you own the same amount of equity no matter what the price is in that situation. Again, what I like to say in an example is, let's say you bought an apartment complex, right? Or let's say you bought a house, for that matter. You own the equity in that property, and the good thing too is that because it's a fixed amount of equity, you own the entire thing, you own a percentage, whatever, that percentage is locked. The loan on that property is hopefully fixed, or it's going to be a little more controlled than inflation. You can get a 30-year fixed loan. Let's say it's at 3%, right? So you got a 3% fixed loan for 30 years. And with inflation, there's going to be an increased cost in operating expenses and in demand. So like paying rent on that property is going to go up because of inflation. And so you're going to be able to charge more as the owner of that property for renting it out. And because you have a fixed rate on the loan, what that means is that you're going to always own that same amount of balance over the years, over 30 years. And what's great about this is that because with inflation, there's more money available in the market, but you have this fixed rate over time, is that the perceived or the realized value of that price, monthly payment for you as an owner, is actually going to go down over time. And hopefully that makes sense to you. Let's say you had a property, let's say it costed you monthly $1,000 for mortgage, but $1,000 today is worth more than it will be in 30 years. So in 30 years, if your mortgage was $1,000, that's going to mean very little to you. So you kind of see where I'm saying that you have that mortgage that's the same, inflation is going to happen, so you're going to be able to charge more rent, operating cost is going to go up, but your mortgage is still going to be the same no matter what with that fixed rate. So that's where the power of just having equity is important, and I think you should find a way to store your money into equity, stocks, shares, even real estate for that matter, just to hold your money in this time where we can expect a lot of inflation to occur and probably in the next year or two. Anyways, that's all I wanted to share, something really quick to get you guys thinking about inflation that's going to happen in the near term. If you like this video, give us a thumbs up and let us know in the comments below how we are doing, and I'll catch you guys in the next one. Take care.